In real estate, if I buy land, I don't get big, huge tax benefits. If I buy land, I don't get to write anything off other than maybe the property taxes and some insurance. But if I buy real estate with something on it, I buy a rental property, a duplex, a multifamily, a commercial, a warehouse, a self-storage, mobile home park, like if I buy the park with the pads and stuff like that, that real estate, those improvements can be depreciated, and depreciation equals deduction. Now, here's where the rich and the poor really separate themselves. A lot of folks are under the impression that you write off real estate over 27 and a half years if it's residential, 39 years if it's non-residential. That is a good starting point, and that's kind of a default that people use, but it's actually not a permissible method. You're not supposed to be doing that. What you're supposed to be doing is taking the components of your real estate and breaking them down into their useful lives. So the IRS will let you, for example, write off a single family home over 27 and a half years, but you could break it into its 5-year components like the carpeting and removable flooring, stuff like that. The appliances, some of the cabinets, some of the plumbing and things like that brought into an appliance. Like think about having a washing machine or a dishwasher, things like that. The platform for it, the cement that it's sitting on, the plumbing that was brought there, the electrical that was brought there. Anything that's attached to an appliance technically takes its lifespan. So all that plumbing and all that electric is actually 5-year property. I go and I look at a fence, I look at a driveway. Those are land improvements, that's 15-year property. Window treatments, all these things have lower lifetimes than 27 and a half years, and you can write them off much quicker. And there's quite often something called bonus depreciation, which means I don't even write it off over 5 years. I might get to write it off immediately. Sometimes it's 100%. It all depends. Every year it's fluctuating around. Congress is talking about making 100% right now. As I'm standing here today at 60%. But I get to write things off much, much faster. And I get to create loss. And if I create loss, then I can use that to offset my other tax. So if I'm a doctor, for example, and I'm making $500,000, and I can create a real estate loss that I can use against that income, it's worth a lot of money to me. Let's say I make a $100,000 loss, that's worth 37% or 35%, depending on what bracket I'm sitting in. I get a big benefit by using those losses. I have some hoops to jump through. I might have to be a real estate professional. So either myself or my spouse is going to have to qualify. I'm going to have to materially participate, or I could do short-term rentals, or I could invest in things that create ordinary loss like oil and gas and stuff like that. I could be investing in those types of projects. But there's really not much better from a tax standpoint than real estate. Literally, I could be making money every year and not having to pay tax on it. So if I have a single family home and it's making net $1,000 a month, but it's depreciated so that in my bank account I have $1,000 positive cash coming in every month, but from a tax standpoint I have a zero because I'm using the building, the deduction for the depreciation against the income, and it offsets. Then I pay zero tax on that. So I have $12,000 a year coming in with no tax. That is a very effective. Now, add some zeros to that, and that's what the rich people are doing, right? So it's always kind of fun when you start digging into these. And so I always say like good, better. Good is, hey, plain old vanilla depreciation is really good. Better is cost seg the property, start writing things off a little bit faster. Best, real estate professional or short-term rental where you can write off those losses as ordinary. And then the insane strategy with real estate is I could sell it, do what's called a 1031, and don't worry, I have 1031 videos if you want to learn about that. If I sell real estate and buy more real estate, and it doesn't have to be 1-to-1, it could be I sell 1 and buy 10, I sell 10 and buy 1. As long as I'm buying real estate and I'm following the rules, which is a 1031 exchange, it's under 1031 of the tax code, I'm using a qualified intermediary, I don't have to pay tax on any of that gain or recapture on the depreciation. All I have to do is 1031 my real estate throughout my lifetime and then eventually pass away. Because remember that step up in basis? It works on real estate too. So again, I could be buying real estate my entire life. It could be going up in value. I borrow against it, spend that money on more real estate or going on vacations or whatnot. All I have to do is eventually pass away and voila, zero tax. Rich people understand that.